Hi, welcome back to this course on infrastructure finance. This is lecture number 38 and we will continue our discussion on the different contexts in infrastructure development. Before we talk about today's topic, we will spend some time to discuss about the thought questions that we had at the end of the previous lecture. We actually looked at different types of competition, if you recall, and we talked about broadly three different types of competition. One is competition in the form of substitutes, and then we talked about competition in the market, and then we talked about competition for the market. So, when you have competition for the market, at any point in time there is only one provider or supplier in the market, but whenever there is there is a bid for the supplier to be selected, there is competition. So, that is where we are talking about competition for the market, that is the different suppliers and providers are competing to provide the services in the marketplace. Okay. So, the two most common arrangements that we have in the case of competition for the market is leasing and concessions. Okay. So, the question was what are the possible problems in leasing and concession arrangements that we could normally think about. Okay. Before we actually do that, let us try and broadly understand the differences between leasing and concession. Okay. So, though both of them are short term arrangements to attract private sector investment, there are some differences between these two types of arrangements. Okay. So, we will look at leasing, and then you have concessions. So, the major difference between leasing and concession is the fact that in the case of leasing, there is no responsibility for financial investment on the private sector. Okay. So, no financial investment from the private sector. Whereas, in the case of concessions, the private sector is expected to make an investment. So, financial investment is needed from the private sector. So, therefore, we can actually apply leasing only those projects or contexts where we can clearly separate financing and operations. So, that means we actually have financing in lumpy which is having lumpy characteristics, that is you need to actually make financing investments only once in a while, and there is no regular financing requirements that are needed. Okay. So, that is actually only those projects can be actually be put under leasing. In the case of concessions, two things. One is you might need a regular financial investment, and second is you may need a substantial amount of financial investment initially, and the government might not be in a position to make that kind of an investment, and therefore they are they are actually inviting the private sector to make an investment. Okay. So, basically if you look at examples for leasing, typically it will include parking space. So, the government would have constructed a parking space. It could be around an airport, it could be in a railway station, it could be in a prominent marketplace, and so on and so forth. In most often the situation is that the government do not operate, the public sector does not operate these parking spaces. So, these parking spaces are leased out to private contractors, and for getting the contract, obviously the contractors will have to pay a fee to the government, and after some time this kind of lease is usually valid for a specific period. It could be 2 years, 3 years, 4 years, and so on, and at the end of the lease period the government or the public sector comes back and rebids the parking space. Okay. So, we are looking at having some kind of competition for the market whenever the lease is being rebid. Okay. In the case of concessions, several examples we see in concession. For example, we have roads where the government provides concession agreement, and the concession agreement in some cases can be for a longer duration, and in the case of airport we have a concession structure for about 30 plus 30, that is total of about 60 years. So, concession is compared to lease is fairly for a longer duration, and but In both the cases there are some specific problems that we need to be aware of. Okay. So, what could be the issues? The first issue is that how the the revenue is going to be shared. Let us say for example, if the person who is actually bidding, if the contract has been structured as a one time upfront fee, then it is going to be very difficult to project let us say the traffic, and when traffic projections is going to be, or the revenue projections is going to be difficult to predict, then the people who are going to bid will actually provide a low bid. On the other hand, if the structure is been the contract structure is done in such a way that there is a share in revenues. Okay. For example, for every rupee of parking fee that the contractor receives, a percentage of it goes back to the government as the licensing fee. Okay. So, we have that kind of an arrangement in many projects these days. So, let us say for example, in some of the airport projects, the concession fee is structured as a percentage of revenue that the project gets. So, when you have a fee structure that is structured as a percentage of the revenue, as the revenue increases, the government also gets better revenue. But if it is structured as a one time upfront fee, then it can work either way. If the concessionaire gets a project by bidding the very low fee and the project becomes a big success, then the government will be pointed and it will be set at fault because they have not been they have actually sold the project very cheaply. Okay. So, we are seeing these kinds of instances in several projects, notably in the case of telecom sector and so on. The second thing that we need to be aware of is the fact that the people who actually won the contract might actually have a short term orientation. So, for the assets to be providing a good quality service, there might be adequate maintenance that is needed, okay, and the asset should have been used in an appropriate manner, so that the capital stock is not eroded. Okay. So, particularly if there is uncertainty in terms of getting the contract again at the time of a rebid, then there would be no incentive for the leasing contractors to actually make an investment on maintenance and to ensure that the capital stock of the asset is preserved. Remember, any investment in maintenance cuts into the profit of the contractor. So, therefore, there will be a tendency to reduce the level of maintenance investments or the level of investments needed to keep the asset in good position. So, to ensure that there is adequate investment being made or the asset is not overutilized, there has to be appropriate clauses inserted into the contractual agreement, and has to be it has to be ensured that the contractors comply to these requirements. That is one. Second is when there is an uncertainty in terms of whether they are actually going to get it at the time of a rebid, and there could be an instance of moral hazard, that is they might the contractors might actually, the existing contractors might actually deplete the assets so badly, the quality of the asset at the end of the lease period or the concession period is actually in a very bad condition. Okay. So, we have to ensure that all of these conditions do not occur in a leasing or a contractual kind of a structure. The second question that we had was we talked about different types of regulatory systems. So, the question was, what are the drawbacks in the different regulatory systems? So, broadly we looked at two types of regulatory structures. We looked at a cost plus, which is also known as rate of return regulation, and we looked at an incentive regulation. We looked at an incentive regulation. An incentive regulation is also called as your price cap, right? An incentive regulation is also called as your price cap. So, what are the drawbacks between these two types? So, if you look at cost plus rate of return, in this kind of a regulatory system, the investor is assured of a tariff which helps him to recover all the costs. It could be operating and maintenance costs, it could be debt servicing, it could be tax, and in addition to that certain specified return on equity. Okay, so, that is your cost plus. Whatever costs that the investor incurs, there is a return on top of that. So, cost plus profit. So, this is your rate of return regulation. And then we are talking about incentive regulation, it is also called as a price cap. So, the tariff increases is limited to an extent whereby the annual tariff increases at a proportion of at the change of the retail price index. So, the retail price index changes by a specific percentage, the tariff increases by a specific percentage, but to have some kind of an incentive for the provider, the tariff does not increase at the same proportion as the retail price index. Okay. So, obviously, the understanding is that the provider would be in a position to improve its productivity and improve the efficiency over time. So, therefore, the tariff increases would be in such a way that it does not increase the same proportion as RPI, but reduces but increases slightly lesser, and by what percentage? By a X percentage it increases lesser than the RPI. So, this X percentage is to account for the productivity increases that the supplier might have been able to achieve. So, this is called as a price cap. Okay. The increases are limited to this extent. Now, if this X is very high, right, if the X is very high, then it is going to be very difficult for the provider to actually get a good return on the investment, simply because achieving that kind of productivity improvements might be difficult. On the other hand, if this X is very low, then most of the productivity gains are actually retained by the provider. Okay. So, the tariff increases, but then the gains also increase because of the productivity improvements. So, ideally the X should be in such a way that it actually gives adequate incentive for the provider to improve, and at the same time it should not be very high in such a way that it becomes very difficult for anybody to actually achieve that kind of X, so that there is no incentive for private sector to come in into the project. Okay. So, the problem with the cost plus regulation is that there is always a tendency for the contractors to actually build costs, particularly when you are actually getting a return that is attractive. So, when the Indian government opened up the private sector, initially there was what is called as a guaranteed return to the equity holders, okay. And this guaranteed return was 16% to the equity investors, which at the time was considered to be quite attractive, because equity returns in developed markets were not so high. They were in the range of about 8 to 10%, but in India they were getting a guaranteed return of 16%. So, this was very attractive return. So, whenever we have this kind of situation, past research has indicated that the suppliers had a tendency to inflate costs. So, what would have been possible to be constructed, let us say in X million, because of the inflated cost it will take X plus Y million, okay, because there is an incentive for the providers to earn additional returns because of the cost plus regulatory system. Okay. So, this used to be called as gold plating, that is, we actually do not need to inflate the cost, we do not actually have to go for a certain amount of investment. So, it is like gold plating, right, we do not need to gold plate the investment, but because the returns are there, we are making this investment simply because to earn this additional return on the larger base cost. So, in the case of RPA minus X, in between these two systems, the rate of return regulation is a simple system. It is it's quite easy to run the regulatory mechanism and so on. Price cap is a little bit more sophisticated mechanism, and in many developing countries, if they have not developed a good regulatory experience, then normally they start with the rate of return regulation before moving on to the price cap system. So, in a price cap system, the trick is to see what should be this percentage of X that will make it that will give an incentive to the private investor, and at the same time it will also give some benefits to the consumers. Okay, so now we will actually go to discussing some specific sector level characteristics. So, if you really look at infrastructure financing and infrastructure projects by the private sector, there are two sectors which actually have got a lot of investment from the private sector. Okay, they are basically the power sector and then the road sector. Even if you look at the PPP India database, you will find these two sectors account for more than 50% of the total projects. Okay, so these two sectors are very important sectors in terms of getting more private investment. So, therefore, we will spend some time to understand these two sectors, the features in these two sectors in some detail. So, in this lecture we will talk about the features of the electricity sector, and in the next lecture we will talk about the road sector. So, if you look at the overview of the power sector, we have really talked about it in the previous lectures as well. Broadly, it can be categorized into three different segments. Okay. And then when you talk about regulation, the regulation encompasses all these three segments. So, you might actually have regulatory regulation looking at generation, transmission and distribution. Okay. So, if you look at generation can be actually from can be divided into different categories. So, for example, at the top you have what is called as your hydel power. So, this is your hydel power where you have dams and all of this, and then you have what is called as the conventional thermal power generation, where you actually generate power by burning fossil fuels. Either it could be in terms of gas, it could be in terms of coal, or it could be in terms of oil, whatever it may be. Okay. And then you have what is called as the nuclear power generation, where we use nuclear fuels to generate power. And then you have what is called as renewable sources or the non-conventional energy sources, which is basically wind. Today you have solar, you have tidal, and so on of the other characteristics. We also seeing increasingly fuels such as biofuels, which is being used for power generation. So, if you really look at it, power generation, though it is a single segment, that consists of several different sub segments. Okay. Then obviously the power that is generated, it is being transported through a electricity grid to the consumers. And if you look at consumers, we can broadly categorize the consumers into 4 different categories. Okay. At the top you have what is called as your industrial consumers. So, industrial consumers are consumers who actually consume a lot of power, and in most of the cases they actually consume power at fairly high voltage. Let us say the domestic voltage for power consumption is 220 volts, but in industries they consume power at higher voltages. Okay. And then you have the commercial segment. The commercial segment again is actually a major consumer of power. So, commercial segment is again a major consumer of power, though the commercial segment does not consume power at high voltages like the industrial segment. They are very concentrated. Okay, in a very small area the demand or the consumption is going to be fairly high. Then you actually have what is called as a residential segment, and the residential segment, the difference is that they actually consume power at lower voltages, and the concentration is not as high as compared to, let us say, an industrial or a commercial consumer. Remember, one industrial consumer will obviously consume many times of the consumption of electricity as compared to a household, is not it. So, each and every household consumer is going to account for a very small proportion of the consumption. And then you have what is called as your rural electricity supply or the agriculture consumption, where again the supply is at lower voltages, but the dispersion of customers is far and wide. You do not really have in a single location a large number of consumers like you have in the case of a residential household. Okay. So, there are differences on the consumer side as well, and this has implication on the cost. Okay. So, the cost of supply, remember when you actually generate power at the grid level, let us assume that it costs the same, but from the grid when you actually take power to the consumers, the cost might actually vary. So, if you are looking at the industrial consumers will actually consume power at higher voltages. So, the infrastructure requirement to actually reduce the voltage of power and then supply is going to be so much more less. So, therefore, the cost of supply to industrial consumer or a commercial consumer is going to be lower as compared to residential and the agriculture consumer. So, between the residential and the agriculture consumer, the cost of supply for an agriculture consumer is going to be very high, because they are actually located in rural and hinterland areas, and taking power to them requires substantial investment in distribution wires, and which actually is going to increase the cost of supply. Okay. In addition, when you actually have very long distribution wires at transporting power at lower voltages, it also increases the distribution loss. Okay. So, therefore, the cost of supply to agriculture consumer is the highest, and the cost of supply to the industry consumer is the lowest. Now, what actually happens to the power price that we charge for the power? Okay. So, if we charge a price based on the cost of supply, the industrial supply should actually be costing the least, and agriculture should actually be costing the highest. But what we see today? What we see today is we are looking at power being provided to agriculture at very low rates. Generally, most of the states the power supply to agriculture has free, and the residential consumers obviously are provided power at subsidized rates, whereas the commercial and the industrial segment pay the highest price. Okay. So, the price that is being charged today in India is not commensurate to the cost of power that it takes to supply these different consumers. So, that is something that we need to be aware of. Now, let us look at the different sources of power and try and understand some characteristics. So, I have actually given the revenues and the profit after tax of three large organizations. You have National Hydropower Corporation, which actually generates power from hydel sources. Then you have NPC, Nuclear Power Corporation, which generates power from nuclear fuel, and then you have NTPC, National Thermal Power Corporation, which actually generates power from fossil fuels, that is mainly coal. So, if you look at the revenues and the profit percentage for each of the three different companies, we can make out some interesting trends. So, National Hydropower Corporation has the highest profit percentage, followed by the Nuclear Power Corporation and then NTPC. Why is that such a big difference? Let us say, for example, the profit percentage of National Hydropower Corporation is more than twice as that of NTPC. What could be the reason for the difference? Now, as we have discussed earlier, the biggest cost for power generation is the cost of fuel. Okay. Now, if you look at the fuel cost for these three different sources of generation, then we can explain the differences in profit percentage. So, for hydropower generation, the cost of fuel is virtually free. We do not actually pay anything for fuel. So, therefore, the profit percentage is a lot higher. Then if you go to the Nuclear Power Corporation, the cost of nuclear fuel is much lesser as compared to thermal fuel. Remember, the technology involved might be very high, the complexity of extracting nuclear fuel might be very high, but then the cost of nuclear fuel per se, the unit fuel cost that is needed to produce 1 unit of power is much lesser for nuclear fuel as compared to coal or oil or gas and so on. So, the profit percentage variations can be largely explained by the differences in fuel costs for this three types of generation. Okay. Now, we cannot simply go and say okay, by the profit percentage as to this is the most ideal source of power. Okay. Now, let us look at hydropower. Hydropower involves a very large dam construction, okay, and such dam construction can actually result in rehabilitation of several people because of villages being affected by floods because of the dams being constructed and so on. Okay. So, the kind of cost that is associated with hydropower, the uncertainty is going to be a lot higher. The externalities of hydropower is going to be a lot higher as compared to thermal power, and therefore, the complexity, the time it takes for constructing hydropower is going to be a lot higher. Okay. So, I am talking about the capital cost. The capital cost for hydropower generation might be a lot higher as compared to thermal power. So, how do we know what is the capital cost? We need to actually find out from the balance sheet what is the total assets. So, asset is an indication of the capital cost. Okay. Similarly, for nuclear power corporation, the nuclear power corporation technology is far more complex as compared to thermal power, and you need to have much more robust structures to be able to operate at adequate safety levels in the case of nuclear power generation. So, therefore, you might actually have a higher construction cost as compared to thermal power corporations. Okay. Now, we need to actually see whether this is actually the case. So, as a homework, I would ask you to look at the total assets for each of these 3 companies and then calculate the return on assets for these 3 companies. So, then you will be able to understand which of those technologies are actually more are giving a higher return per rupee of investment. Okay. Second is, you should also understand the risk levels that exist between each of these 3 different technologies. Okay. If you look at nuclear power corporation, it has a high degree of technology risk, it has a high degree of safety risk as compared to the other 2 sources. So, therefore, you do not find large in fact you find very limited private sector participation. In India, if you look at it, there is virtually no private sector participation in nuclear power generation. Next, if you look at hydropower, hydropower involves is a lot more challenging politically to implement because a large number of people might be affected. They may be displaced because of the dams being constructed and so on. And many cases construction of dams is also associated with irrigation and agriculture and so on. It is not just considered as generation of power. So, because of the multifold objectives that we have in hydropower projects, it is very limited participation in private sector. Large hydel projects are still prerogative of the government. We are of course seeing private participation in mini hydel projects. We are also seeing some amount of private sector participation in those areas where government is finding it difficult to make investments. And the least risky as compared to among the 3 is your thermal power generation, and most of the private sector plants are today in thermal power generation. There are a lot of private sector projects that are coming in the renewable energy sources like wind, like solar and so on, but these segments have not really grown to an extent to kind of meet the kind of reliability that we have in the conventional energy systems. Even in the case of wind and solar and so on, practically the capital cost is going to be very high because there is virtually no fuel cost, right. There is no fuel cost for we do not pay anything for generating power using sun rays. We do not actually pay anything for wind, the cost of we do not pay anything for the cost of the wind that actually rotates the turbine in the case of wind power. This is a schematic representation of power project financing. We have actually looked at these kinds of structures in our original discussion on project finance, but just to kind of recap whatever we have done so far, I am presenting it here. Okay. So, largely you have the project company which is in the center, and then there are various agreements that the project company has. So, the project company has an agreement with the lending bank, which is a lending agreement. Then the project company has an agreement with a construction contractor, which is your EPC contract. Then there is an agreement with the operator, which is your operation maintenance agreement. And then what I have missed here is also called as a fuel supply. So, the project company's agreement with the fuel supplier is a fuel supply agreement. and then you have the project sponsors who actually provide the shareholders agreement. Okay. Then there is an agreement with the host government. Remember, whenever we have an agreement with the host government, we are not really talking about a very competitive situation. Right? In a competitive situation, agreements and support from the host government is not expected to be provided because the market is competitive. So there is an agreement between the host government and the lending banks. So that means the government actually provides some kind of a support that if the lenders have not been able to recover their investment from the project company, then the government will be in a position to pay up the lending banks. Okay. And then the project company also has an agreement with the purchaser of project output. So that means there is a power purchase agreement who will actually purchase the power that is generated at specified tariff levels. Okay, so now there are different types of power projects. Before we actually look at the different types of power projects, let us look at some of the broad characteristics of the demand for power. Okay. The first thing that you should be able to understand is the demand for power is very fluctuating. Okay. So even if you look at a single day, let us say for example you have time of the day and then you have power demand, let us say this is 4 a.m., this is 8 a.m., this is 12 noon, this is 4 p.m., this is 8 p.m. and this is again 12 midnight. So this is the different time of the day, and how is demand or how is the consumption varying throughout the day. So obviously at the early part of the day the demand is less, and then as the day begins and people start preparing to go to office and so on, the electricity consumption increases. So it peaks around the period of 8, 9 and so on and continues to stay, and by 12 o'clock when most of this early morning needs are met, it falls slightly. But because of the fact that there is a lot of demand from the commercial, that is a lot of offices and so on, there is still substantially high demand. Again it proceeds, and then towards the evening time again when people come back from offices, the demand from the residential segment increases, because that is when you need demand for lighting, demand for cooking and all of this. Again it tapers down as the night progresses, and towards the end of the night it still reduces, right. So basically what you actually see is you see the demand or the consumption of power fluctuating within a day. Okay, so that is one. Second is you will also find the demand for fluctuating during the year. Okay, so you want to plot a similar plot now as say time of the year, then you have your power demand. So let us say we have January, we have April, and then we have June, and then we have September, right. So if you really look at from the Indian perspective, the winters are not very harsh. So we do not really use very large heating load during winter like the people use it in the West, like Europe or the US. So for example, in those countries the winters are very severe, where temperatures go down to -20, -30 even in large populated areas, main cities. So we need a lot of electricity power for heating loads. Okay. But in India we do not really have that kind of large heating loads. So therefore the power demand during the winters in India is fairly low. Okay. But what happens in India is we have very heavy summers where temperatures are very high. So therefore during summers there is substantial heating, air conditioning load, cooling load. So therefore the electricity demand during the summers are higher. So let us assume that in January the load is low, and then it gradually rises as April comes and continues at a higher level till about the end of summer in August, and then gradually tapers down, correct. So during the year also there is a substantial variation in the consumption or okay. So we need to understand, right, we need to understand it's very important. So, this this load, this demand that exists throughout the day, let us say for example this demand, this can be called as let us say the base demand for power, right, base demand, right, and then the demand for power that exists at this level can be called as your intermediate demand, and then this can be called as your peak demand. This can be called as your peak demand. So, the demand peak demand is not there throughout the day, but to avoid blackouts, we have to ensure that this much level of capacity is available so that electricity can be generated when needed. Okay, so, that is very critical, right. This level of electricity should be generated whenever the demand picks up, and if we are not able to generate, then there is going to be a power shortage. Okay. Now, with this understanding, we look at the different types of power projects. The first is your independent power projects. Independent power projects, basically they have a power purchasing agreement, there is a purchaser, and therefore, to a certain extent the demand and the revenue risk is so much more reduced, because there is somebody who signed a contract who is willing to purchase the power that is being generated. The next category is a tolling plant. Tolling plant can again be divided into two categories, a tolling plant where the contract is with the fuel supplier, and a tolling plant where the contract is with the purchaser. Now, when they say the contract is between the project company and the fuel supplier, or the project company and the purchaser. So, in a tolling plant what happens? In a tolling plant, the contracting counterparty decides when to operate the plant. Let us say for example, you have a fuel supplier, the fuel supplier decides when he will actually operate the plant. If we have a purchaser, the purchaser will decide when he will actually operate the plant. So, the project company is given return on equity, it is actually paid a capacity charge which will help him to recover the investment and also provide a return for the investment that is being made, and whenever the project runs, whenever the power plant runs, then the supplier or the purchaser provides what is called as the operation charge, or the charge that is needed to run the plant. So, if you really look at IPP and the tolling plants, both of them they have very limited risk, because the way the contract is structured, there is almost a certainty in terms of recovering their investment as well as a return on their investment. Then you have another category of project called as your hedged IPP. IPP is your independent power plant. So, in a case of the hedged IPP, we have what is called as your contracts for differences, that is the power plant generates power and it supplies power to the power market, and simultaneously there is also a contract between the power plant and the power purchaser, which is called as the contracts for differences. So, if the pool price, that is if the market price for power is beyond what has been agreed at the contracts for differences, then the difference in price will actually be settled between the project company and the contracting counterparty, depending on what the difference is. Let us say for example, there is an agreed upon price, and if this agreed upon price is lower than the market price, then the contracting counterparty will pay the difference to the project company. Right. Similarly, if the agreed upon price is higher than the market price, then if the agreed upon price is higher than the market price, then the project company will pay the difference between the two prices to the contracting counterparty. So, there is a contract for differences. This also ensures that the revenue stream is more or less stable, but there is a slight risk in the case of a hedged IPP as compared to IPP and a tolling plan, because the duration of the hedging contract is much lower as compared to the life of the power plant. You have an IPP power purchasing agreement for 15 years, 20 years, you will probably also have a tolling agreement for a longer duration, but a hedging agreement is usually for a 4 to 5 year period. So, at the end of the hedging contract period, you will again have to renegotiate a fresh contract. So, we do not know what is going to be the situation at that point in time. When there is, let us say, an excess power supply, then people will be able to negotiate for a lower contract for differences price. The fourth category is called as a merchant power plant. A merchant power plant has no contracts and it sells its output directly into the electricity commodity markets. So, by its very nature, therefore, merchant power plant will function only for a limited amount of time, and in most cases merchant power plants are used only to supply power during the peak demand. Okay. So, the merchant power plant will then have to recover the investment costs and also get a return during the limited time that it functions, and therefore, the tariff that the merchant power plant charges is normally going to be a lot higher as compared to, let us say, a base load power plant or intermediate load power plant. Now, what kind of power plant is going to be that is going to be financed has a lot of implication in terms of how are we going to finance it. Okay. Let us say, for example, we have broadly, let us say, two different categories of power plants at the extreme ends. On the one end we have the merchant power plant, and on the other end you have the tolling power plant. Okay. So, in a tolling power plant, because of the fact that we actually have lower risk, because there is adequate certainty in terms of revenues and so on, the project will be able to get a higher amount of debt. So, the project normally gets funding more than 80% of debt, as whereas in the case of a merchant power plant, the debt is to the level of about 45 to 65%. And this has implications obviously for the weighted average cost of capital. We have already seen earlier, cost of debt is lower as compared to the cost of equity when the project is being funded by a higher proportion of equity. Therefore, the weighted average cost of capital is also going to be higher. So, therefore, for a merchant power plant, the weighted average cost of capital is higher because it has a higher proportion of equity. Now, let us look at the economics. Okay. In the case of a tolling power plant, the economics is capped because of the fact that you have a power purchase agreement. Even if the market price for power increases to your advantage, you will not be able to take advantage of the fact that there is a contractual agreement that has been signed between the project company and the power purchaser. Let us say, for example, if there is a sudden demand for power in the economy, in the country, because of growth in economy and all of these things, and it will not be able to take advantage of, let us say, the sudden increase in demand, provided there is no corresponding increase in supply or capacity, simply because you actually have a power purchase agreement, and you will have to, under normal circumstances, honor the terms of the power purchase agreement. Okay. So, the upside is capped. You may not be able to take advantage of any sudden increases in power prices, but whereas in the case of a merchant power plant, since there is no contractual agreement, you can always sell at the market price, and if the market price increases, then obviously it is going to be a big advantage. So, any such increases, the benefit of the full upside is going to come to the merchant power plant. Let us look at the equity discount rate. Okay. The equity discount rate is going to be lower for a power purchase agreement, simply because the risk levels are also lower, and for a merchant power plant it is going to be higher because of the higher levels of residual risk. What is a typical financing strategy? A tolling PPA basically finance it as a single project. Okay. So, each and every project is considered as a single asset and financed accordingly. And so, given there is kind of certainty in terms of revenues, people also use leasing transactions. So, whenever you use leasing, there has to be adequate certainty of revenues, because your lease payments are contractual. If you do not have revenues, then you may not be able to meet the lease payments as per the leasing contract. In the case of a merchant power plant, each and every project might actually be highly riskier. So, therefore, instead of financing as a single asset, you finance it as a portfolio of assets. Okay. So, that even if one or two of the projects are experiencing problems, the other projects are able to provide returns for the investors. So, that is one difference. We actually do it as a portfolio project. Second is you do not actually have merchant kind of provisioning for the entire capacity of the plant. So, you have what is called as a partial merchant or an anchor tenant. That is, there is purchaser who is willing to purchase power up to let us say 50% or 40% of the project capacity, the remaining 50% or 60% is treated as a merchant power plant. So, that is a guarantee, there is a guarantee for certain amount of power that is being generated, and only the balance is under the risk category. The third financing provision that you normally see is subordinated fuel. That is, usually what happens, there is revenues and then there is operating costs. In operating costs there are fuel expenses, and after meeting the operating costs is when the debt holders will be paid. But when you are talking about subordinated fuel indicates that the fuel payments are subordinated to debt holders payments. That is, the debt holders are paid first, and after that only are the fuel suppliers paid. So, this is one of the arrangements that you actually find in a merchant power plant, because the lenders would actually find this a lot more comforting, because they get their payments first even before the fuel suppliers. And because of the fact that the revenues are not so certain, it is not going to be easier to actually go in for leasing kind of a transaction, okay, as compared to a PPA where we see leasing more common. And we should also understand that the DSPR target, that is the debt service coverage ratio target, that are determined by the banks is going to be a lot different between these two. Okay. In the case of PPA, the debt service coverage ratio is in the range of 1.4 to 1.5, whereas in the case of merchant power plant it can range anywhere between 1.7 to 4. So, this indicates that people will actually, investors would actually look for a higher margin, higher coverage as compared to a merchant power plant. Okay. In case if you do not recall what is the debt service coverage ratio, the expression for debt service coverage ratio is nothing but you have earnings before interest, tax and depreciation in the numerator, and we divide by the denominator by your interest payments plus your principal repayment divided by 1 minus tax rate. So, this indicates how comfortable the project company is in terms of honoring the debt, that is the principal as well as interest repayments to the investors. Couple of broad trends that we can see today in project finances. Markets are moving from a regulated to the unregulated structure. That when we talk about regulated, that means we are moving from a rate of return regulation to a completely competitive structure. Till recently we talked about a mature market, where this is largely a statement that is applicable for developed countries, where we had all debt financing, that is a project was being funded by even 100% debt, at least during the construction phase. And how is it possible? Because during the construction phase there is a guarantee from the project sponsors, and this guarantee was adequate for the debt holders to provide for 100% of the project construction. Once a project begins operations, then the loan was refinanced, and at the time of refinancing is when the equity contribution from the project financing came in for the project company. Normally the funding was done as a two-step process. In the first step, bank loans were obtained, and then this was subsequently refinanced by the capital markets. Okay. So, the question that we have is, why do we actually have bank financing in the initial stages? So, we actually talked about it in the earlier lecture. We talked about the concept called the negative arbitrage. That is, when we actually take money from the capital markets, all the money comes upfront. But when you go for bank financing, we are able to withdraw the money based on our needs, and when all the money comes upfront, the interest is due right from the day the money is being obtained for the project company, and therefore there is a surplus capital that is always available. We do not need all the capital upfront. Construction happens over a period of time, and if you get all the money upfront, then the interest will have to be paid, though all the money is not necessary at that point. Whereas when you look at bank financing we actually withdraw at multiple stages depending on the requirement, depending on the stage of construction we are in, and it helps to actually have lower interest payments, because we start paying interest only from the time of withdrawal. Okay. So, there is this concept called the negative arbitrage, that is the surplus capital that we have raised from the public markets. if we invest it in other marketable securities, the returns that we get from that will be lesser than the interest that the project company will pay to the bondholders. So, this is called as a negative arbitrage. So, there is something called construction pools. Construction pools is nothing but constructing a portfolio of projects rather than looking at financing each of these projects individually. When we finance as a single asset, then there has to be a negotiation, there has to be a transaction for each and every project. So, this actually results in substantial transaction costs and fees to the bank. But if you really look at financing a project as a portfolio of projects, then we do not have to approach the bank for each and every project. So, the entire financing transaction done at one stretch and the transaction costs are minimized if you are financing as a portfolio of projects. So, to complete this lecture, we have a couple of questions as usual. We have two questions for this lecture. Question number one is, what is an important feature of electricity production that impacts investment in the sector? The second question is, many infrastructure companies in India have what is called as a holding company structure. What is an advantage of this structure? Okay. In case you are not aware what is a holding company structure, we will discuss it in the next lecture, but I want you to think about what are the advantages of a holding company structure.